Welcome back to another episode of SoFi Weekly, episode 4.
I gathered a bunch of the news around SoFi that has nothing to do with the quarterly earnings. First off is the stock. There's some updates on options. So if you look at the top, 2 weeks ago in the code, options had trade options beta changed to just trade options, and you could see some progression. So options looks like it's getting close. We don't know when it's coming, but the code looks like they're getting prepared.
Noto also mentioned in the Q3 earnings call that they were in the beta testing round as well, and that they're still on track for end of year.
New APY is up to 3% for savings accounts, which is amazing. And it also incentivizes SoFi users to keep money in the bank and not spend it. SoFi Plus rollout messaging has changed from weeks to months. If you were to call SoFi a couple weeks ago and you talk to a rep, they would say by the end of October, SoFi Plus should have been rolled out to all members. But now the messaging has changed. They're still in beta and they're going to be rolling it out in the upcoming months. Something really new is the SoFi Relay Insights. User interface has changed for SoFi Relay and it looks a little bit more slick. This might just be an Android thing as of right now. I go to the future products. Bender has a wealth of knowledge and he's just highlighting all the products that we know SoFi has talked about or if there's been any documents relating to them. Okay, moving on. Anthony Noto just started posting a lot on Twitter. There was this really interesting exchange between Alexandria Ocasio-Cortez, Elon Musk, and Anthony Noto. Noto replies with an idea of how Twitter can be monetized. People saw this and noticed it. Investor Gadget, he goes out and asks Noto if SoFi could do a partnership with Twitter. Noto says if they switch their direct deposit to SoFi and paid $8 a month to Twitter Blue via SoFi account, we would refund the $8 a month to their account for 12 months. That way we can do it with the zero integration equals 1 year free.
It's going to be a SoFi Plus member benefit for sure.
They could also do this with other companies in terms of diversifying their perks for SoFi Plus or for their direct deposit members. Because of that one line that he said there, it requires zero integration. In other words, Twitter doesn't really need to do anything. We're just refunding you money that you would have otherwise had to pay Twitter. They can just do that for anything. You want a Spotify membership? Cool. Netflix membership? Cool. Like whatever you want, and you can have a diverse set of pick your own perks, basically.
Anthony Noto wants this deal coming. He wants to do something with Twitter for sure. Anthony Noto is trying to get this in front of Elon Musk.
They don't need Twitter's permission to do this. Right.
It sounds like Tannor that he just wants to get his attention so that he can open the door for something further.
After this, people just started blowing Anthony Noto up. He just says the positive response to our idea for SoFi to help you pay for the Twitter Blue was so positive we decided to do it. Basically, SoFi ended up tweeting this. Within hours, it got 1,897 retweets, which is insane for SoFi. This is on their radar for sure.
I think he did 2 interviews after the Q3 earnings, one on CNBC, one on Yahoo Finance, and on the CNBC one, the host basically asked him about the checking and savings. He was just like, I check my Chase every day and I'm getting 0.1%, and you should see the biggest grin on his face.
And it's so true though. I just saw someone recently actually just visualize this, where all the deposits for all the traditional banks have all been going down in the past year, but yet SoFi has been climbing like crazy. Some of that is probably because we were starting at ground zero and we don't have those large deposits to begin with, but also we just offer a better product. Do you guys want to jump into some numbers?
Get into earnings.
Adjusted net revenue. We now saw a new highest high, record-breaking $419 million for SoFi. This was up 51% year over year. This is all record revenues across all 3 segments of our business. $44 million of record EBITDA. This was up 118% quarter over quarter. It took us 3 months to do more than double our EBITDA. It's because we went from not being a bank to being a fully chartered bank. It allows us to really, really lower the cost of funding our loans, and that's really going to ramp up the bottom line. This is expected to grow even more whenever we look at Q4 and then even higher in Q1. So very, very exciting.
It was their 6th consecutively higher quarter. Also to see just that trend of the compounding growth.
SoFi Bank has accelerated their growth in their deposits up from $2.7 billion of Q2 up to $5 billion in deposits this quarter, 86% quarter over quarter. On top of that, the amount that we're actually paying for these deposits versus our other forms of debt is now at 125 basis points cost of savings. Just to really dumb that down, let's say that we're offering people 2.5% in our checking and savings. A bank can use those deposits to fund their loan. If we weren't a bank, we would have to get what's called warehouse facilities, a big amount of debt that we can go and dive into. For our warehouse facilities, it's around 3.75%.
Wow.
Those deposits, if we can get instead of 3.75, we only get 2.5. That's a 1.25% savings on all the dollars that we actually use towards our lending.
Just because we're a chartered bank, the unit economics are just way more compelling than competitors.
Before we wouldn't really have that option at all. This is the reason why traditional banks have such low ratings, like 0.1% in their checking account, because think about the difference between warehouse facilities at 3.75% and deposits at 0.1%. They are making a crap ton of money. That's why they're so profitable. But whenever you're the customer, you're getting a little bit shafted that way.
Basically, Anthony Noto had this as one of the quotes in the ER, and he mentioned this in the earnings call as well. In that same vein, where total deposits grew 86% during the quarter, so from 2.7 to 5, he also mentioned that 85% of SoFi money deposits, so this includes checking and savings, are from direct deposit members, and half, so 50%, newly funded SoFi money accounts are setting up direct deposit by day 30 versus only 37% that did it in the second quarter. So basically, more people are setting up direct deposit by day 30. This has a significant impact on debit spending. I feel like a lot of people might have gleaned over that fact, and so I wanted to bring it up to see what all y'all thoughts are.
Love it. And this is not overall. It's not 50% of people are doing direct deposit. It's 50% by day 30. People are actually transitioning to already consider us their primary bank. And I bet you it's going to be even higher in Q4, considering we have this 3% offering now.
It also shows that their MAUs are actually engaged. The fact that they're actually putting their money into the bank direct deposit.
Obviously, it's very positive for SoFi, but from a user perspective, is that just a direct consequence of the APY being higher? Like, because the APY is higher, that incentivizes more people to say, hey, look, I want to be banking with SoFi as opposed to having multiple accounts.
What do you think about the idea that this is a direct correlation to the brand awareness of SoFi Plus? People love being a part of this club, right? And getting all those perks is like a little bit exclusive. And I think that's great for people.
It also, I guess, it speaks to this internal motivation of wanting this one-stop shop to do stuff.
I felt like this was the quarter of the financial services segment. This is really where we're starting to see the true power of the financial services segment. For the longest time, people only talked about the technology platform and lending. And now the conversation is more along the lines of lending, obviously, because it's our top driver, but also financial services cannot be slept on because it's doing really, really well. Financial services sales and marketing spend as a percentage of net revenue was 58% in Q3, which is high, but comparatively to last quarter, it was 81%. Comparatively to last year, it was 105%. We're charging less to get these clients, and we're actually, getting a better client out of it. Obviously, they're cross-selling into personal loans. I'm not as excited as the average person for student loans. I mean, the actual income that we can make off them, our actual margin, isn't nearly as high as a personal loan.
One thing that I will say around that is one of the reasons that might not be front and center around the student loan moratorium ending and them coming back. Like, a lot of people are taking that at face value to say, okay, well, in a CNBC interview this week, Anthony Noto basically said that we're operating at 25% capacity. So just quick math, you can just multiply by 4 to say, okay, where would I very roughly, anchor myself for student loans? But the layer beneath that is that cross-selling flywheel. When student loans was essentially halted back in March of 2020, the ratio of financial services products to lending products was about 1.3. Fast forward 2 years later, that ratio is 4.6. So in other words, there's 80% financial services products to 20% lending products. And so when the student loans gets turned back on, what you'll see in that productivity loop is so much higher than what it was in 2020, because during this time that student loans has been basically turned off, the infrastructure, the scaffolding has been built on the back end, so that now that it's back turned on again, there's so much more that a new person can do on the SoFi ecosystem. When they're just starting off with a student loan, they can cross-sell so much more easily.
Let's put one question up from Nate, just to play sort of a devil's advocate. Does the massive uptick in personal loans scare you? I know we have higher FICO users, but if they are really higher income, why are they taking out personal loans?
Can I actually answer this with a clip?
Well, the higher interest rates as a result of the Federal Reserve raising them to try to offset inflation and cool down the economy is driving a refinancing boom for personal loans. People are refinancing out of revolving rate debt into fixed rate term debt. And so that business is definitely benefiting from that trend.
As a result of rates being higher, and more people are using personal loans for SoFi because they're going out of that revolving debt into a fixed debt. And that's one of the reasons why personal loans is so much higher. The higher rates might hurt home loans, but it helps personal loans, and which is good, right? Because personal loans, you have just a higher margin on that as SoFi.
What's really, really surprising here is that for the last 2 or I even think it's 3 quarters for lending products, these have been the fastest growing quarters that we've seen since we've been around. I mean, even as a percentage basis year over year. It's so much harder to continue a growing pace like that because you're going up against now a higher amount of lending product. We continue to pull it out and really, really succeed on our lending product sales. And it's probably because we really front-ended all of our financial services products, SoFi Money, SoFi Invest, and then we're able to cross-sell them over. For the longest time, and I've been a believer of this as well, is that the SoFi Money clients that we have would be of much lower credit score than our actual personal loans or student loans. It's actually not true. So they just announced that the median FICO score for direct deposit accounts opened in the third quarter was 750. But yet the same thing for personal loans was 746. Our SoFi Money direct deposit users are at 750 and our personal loans are at 746. We can fund all those people on average. We can take on that risk because they are good risks to take.
What's the lower band, lower threshold cutoff for a loan that SoFi might? Do we have a general? Is it like 700 plus, 720 plus?
Yeah, from what I know, it's 7 plus.
That confused me because I remember like my credit score was like at 700 at one point, and SoFi was like, yeah, you can have this credit card. It's really interesting. This Jack Dorsey is doing this with Web3, supposedly. Banking in the future are also going to be providing identity services. Today, now, like, what's the best like type of indicator of who your identity is? Signing a signature, because we all know that can be forged, and signatures are kind of outdated, and we're all doing it just because everybody else is doing it. How many kids under the age of 21 has used a fake ID to get into a bar? One thing about banks in the future of fintech is they are going to be providing identity services because nobody can have your money. They have to protect your money. And if you're the one that owns your money, that's a pretty good indicator of who you are. That's one thing that's really hard about building a fintech company today. If there is a fraud problem, you're legally obligated to solve it. So they're very well incentivized to solve fraud problems on a large scale. And a good application of this is we're already kind of seeing this. Like, you know how like you go to download an app and you can be like, log in with Facebook, log in with Apple. It might start shifting 10 years from now to fintech services or a bank where it's just like log in with SoFi. You want to apply for this loan, log in with SoFi. Then they won't have to use the FICO score. They can just immediately use SoFi and give you an offer like immediately. There's so many cool parallels that I love about this company, and that's one of them.
I want to talk about guidance. Prior guidance to new guidance, that went up $9 million. But EBITDA, the amount that's going to the bottom line, went up $11 million. So not only are we getting a free $9 million that's going straight to the bottom line, we are also getting more efficient on our existing amount of revenue already.
When do you think SoFi is going to be profitable?
I was about to ask this exact same thing. Okay. So it's split into two camps. From what I've been seeing right now, from YouTubers to FinTwit to institutions, 2024 and 2023. I'm in the camp where I say like Q3, Q4, 2023. The whole entire thesis is if we get some type of Fed pivot, we'll see if it happens, if it doesn't happen. But if it happens and student loans are coming back and options, I think Q3, Q4, I was really encouraged by the trend in the net losses this quarter. We went from over 100 million net losses in Q1 to something like 90 million in Q2 to like 77 million in Q3. If that trend continues, we're going to see a profitable quarter by Q3 or Q4.
It's all macro for me, but it'll probably be a year from now. If I were to take a guess, if everything stays the way it is, I'd probably say Q3 at 23. We seem to only be getting 400,000 new members, but this is kind of by design. This is an exact quote from SoFi. Like, people think that we're having slowing growth. It's not true at all. What I'd say is that we're really trying to target high quality members with good compounding growth over years, not over any one quarter. So we're targeting around 400,000 net new members adds per quarter. At some point, that could take a step function up, but right now we're sort of balancing the growth of our member base with quality, as well as making sure that we're building our technology and processes to meet our members' needs while we scale so meaningfully.
Just to piggyback on that, one thing I will add, just to put into perspective, because as the company gets bigger, as a percentage of total members, if we grew 400,000 every single quarter, it looks like a much smaller percentage if we have 10 million versus 1 million. But 400,000, let's just annualize that and say 1.6 million a year, right? 400 times 4 quarters. That's more than the total members we had 2 years ago. right? That's more than Q3 2020 total members. 400,000, it might not seem like so much in the context of 4.7 million members, but you got to keep in mind that 2 years ago, all we had was 1.5 million members. It is growing very fast. You look at the percentages, but also look at the actual numbers in aggregate. And it's been pretty consistent in terms of if you get the median of the last 6 quarters, you're at around 400, 420, something like that.
I wanted to quickly touch on, this is going to be super quick, Robinhood earnings. Total net revenues increased 14%, and there's transaction-based revenues. This is the big deal. It actually increased.
When we're talking about transactional revenue for Robinhood, we're not talking about directional, right? Like we're not talking about there was more buying versus there was more selling. All of it counts as a transaction, right? So it could have been a lot of people just shorting, buying put options, whatever, like being negative on the market, but they're still doing more of it.
When we talk about Robinhood and then SoFi, this is in the code right now for options. It's going to be released, but you can see like the type of verbiage that SoFi is offering on the bottom picture. They're really like focused on, let's make sure that we're doing the right thing for you and that you're actually making smart decisions instead of just encouraging you to trade a bunch and make a lot of money for SoFi.
No confetti coming down on your screen when you're just YOLOing into AMC.
That's a good point.
Do you guys know what the average revenue per user is for SoFi? Let's talk about it. Think about it this way. Robinhood made over 50% of their earnings from options. So remove options, that's pretty much what SoFi's average revenue per user is. So average revenue per user is at $33 per person on their financial services. So that's SoFi Money, SoFi Invest, credit card business.
Why would you buy Robinhood? It's just so crazy to me.
And they don't have a loan there. They don't really have a great lending section or making any sort of money on that either. And we have all these other segments. The only thing we don't have is 20 million users, right? And that is a big difference. But let's just talk for a second. Average revenue per user quarter over quarter is up 46% for SoFi. But if we start to introduce options, this could double our average revenue per user for SoFi.
The banking app that SoFi offers sucks. I can't imagine 6 months from now when they start actually maybe changing this app to where it's super awesome. Whenever you actually have an app that actually looks as slick as this, you're going to want to actually share this with your friends more often and actually take a part in those referral rewards. Because I when I had the Robinhood app, I never like shared it with my friends. Either they already had it or it just felt cringy. Like, hey, dude, get my referral bonus.
I really like the Robinhood app. I think they probably have the smoothest app in the space, in my opinion.
My point exactly. I think SoFi's app sucks so much that I wouldn't want to like actually do a referral because it's not well furbished. But if it was like Robinhood, I would be way more inclined.
We're just making sure that the processes work fine, the fees are low, and the interest rate that you're making is great.
This would actually be an interesting thing to test. I understand the strategy of SoFi building all the back end before they pretty up the front end, but it seems to me that from a user perspective, the front end or that easy user experience is just as, or maybe even more important than SoFi actually having all of the features. Because if so, SoFi could have feature parity with Robinhood or like a one-to-one thing, or they could even have more features in Robinhood and people would still use Robinhood because it's so much easier to use and so much more user-friendly. In which case, in the short term, purely, it would hurt SoFi that they're working on all the infrastructure on introducing new features, like introducing options trading, for example, versus them making the app less laggy or them making it actually more usable and easy to use, if that holds true. Anecdotally speaking, it really does, because I want to have an app that's easy to use. I might be tech savvy, but then somebody else might not be tech savvy. And so it's just a blanket thing that you want to have for your apps. And so this approach of like building the features first and then making it pretty might have short-term consequences or repercussions. Doing it the other way around, it might give you another response in terms of the actual users.
100%. And I think SoFi has always taken this really hard route of doing the things that don't necessarily pay off the strongest in the short term, but are the best for the company in the long term. Also, with going after these super high FICO score clients, it's so easy to go after the clients that Robinhood's going after. SoFi is taking an approach where CAC, our customer acquisition costs, are actually much higher. We're going after such higher clients that is worth the potentially bigger risks, but way bigger rewards.
Can we touch on this analyst re-rating for just a second? It's going to be a super quick topic, but basically after earnings, earnings, analysts generally re-rate stocks because they have more information and then they can plug it into their models. Bank of America has a $9 price target, which is, I think, one of the highest. Mizuho and Wedbush have $8 price targets. And then you have Morgan Stanley and Goldman Sachs. Both of them lowered price targets on this earnings. Goldman lowered the price target from $8.50 to $7.50 for SoFi. So somebody commented on Twitter saying like, the stock price action is breaking my heart. And then Noto said mine too. Like, he responded to it. Interestingly enough, 2 days ago on November 2nd, an article came out on Investor Place and it was like the top 5 investors betting against SoFi. Guess who was number 2? Goldman Sachs with put options against 6.25 million shares. How is this a reality where the same institutions that are rating a stock can also trade that same stock? It just opens the door for so much manipulation. There's a couple of consequences too. Like, it creates this artificial sort of paradigm with regards to small cap stocks. Like, SoFi has one of the highest short interests out there of a lot of people shorting, or in other words, betting against the stock, betting for it to go down. If you have Goldman as an institution who has a long position, in other words, they have shares, and their end goal long term is to accumulate more shares, instead of just buying in, like DCAing only long investor, what they do is they will bet against the stock and then they'll create an environment where the stock goes down, where they're basically recommending that everybody else bet against the stock or sell their shares because it's not a good investment. They'll make money on the way down, and then they'll remove their shorts and then turn those into long. So without proceeds from betting against the stock, when the stock is depressed, they'll just buy way more. And then what will happen is they'll raise their rating again. And let's say this is a good buy now, and profit on both sides, on the way down and on the way up.
Those same people that downgrade the stock, as the earnings call are going on, they have their questions for Anthony Noto and Chris Lapointe. They go, "Hey guys, great quarter, love it, blah, 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 downgrade."
I found it really interesting that Anthony Noto actually acknowledged the stock price breaking his heart as well. Like, when somebody on Twitter responded, because Goldman Sachs was leading the charge and Goldman was like Anthony Noto's old stomping grounds. He knows exactly what's going on. Like, he knows what's going on in that organization.
He was like the top analyst at Goldman Sachs for like 8 years straight. That he knows exactly what that.
He
That's
knows
such a
it's
good
manipulation, and it's ridiculous.
I want to like talk about SoFi Pay in 4. Anthony Noto said something pretty interesting on the call, and that is going to be the first product that Galileo and Technisys actually work together to build. We've been focusing on this for quite some time because there's certain distribution models when it comes to buy now, pay later that some like companies stick into. SoFi wants to capture it all. The idea is SoFi is going to be able to offer their own buy now, pay later to other businesses. A lot of these companies that are all in these little silos of like, we offer buy now, pay later for like insurances or like medical like companies, or just like direct to consumer and stuff like that, or merchant suppliers. But SoFi is going to build the infrastructure so that like any of these businesses and any of these models can like come and test their product out, which I think is going to be really cool.
Probably what's going to happen from this is 2 things, right? Like, number 1, we're going to get a SoFi branded buy now, pay later product. And number 2, we're going to get Galileo infrastructure backing for a B2B offering for buy now, pay later for other businesses to do it through SoFi, powered by SoFi.
So wouldn't that fall under the 2 categories of credit card issuer and white label provider?
This is going to be like SoFi branded, one of their many products that's going to be under their umbrella in 10 years from now.
I have thoughts on this, man, because it really depends on whether you're bullish or bearish on buy now, pay later as a whole. If SoFi wants to provide it B2B through Galileo to somebody else, then that's one thing. That's definitely fine. But if SoFi wants to brand the SoFi branded buy now, pay later, like, then we're going to go into this conversation of like, buy now, pay later had this entire wave in 2021 with Afterpay, Klarna, Affirm, all of these sorts of companies rushing to do it. Right now, we're seeing like consumer credit is like all-time highs. Like, people have high debts. They have low savings as a result of what's going on in the macro. The only saving grace that I see for SoFi that's a positive for buy now, pay later is the 750 FICO score. Like, their consumers are really financially secure, or they're financially responsible. Let's put it like that. But buy now, pay later as an offering in itself had a huge boom. But right now we're in a part of the macro that does not really support buy now, pay later. It's not very friendly to a buy now, pay later service because of racking up consumer debt.
That's the short term, but I think in the long term, buy now, pay later isn't going to die. I really think next quarter, we're actually going to see a lot of like new, unique partnerships about this.
I'm pretty bearish on this buy now, pay later. Not a big fan at all. I like buy now, pay later. Okay, but let's make sure we're both understanding the offering that Affirm is offering is 100% different than the offering that SoFi is offering. Affirm can make money. SoFi cannot make money.
I've seen buy now, pay later being done in two ways. Either you have really good credit and you get a 0 interest breakdown over 1 or over 2 years, or you have bad credit, in which case it's the same interest rate as it would be for a credit card for a buy now, pay later. Like if you're trying to do buy now, pay later and you have bad credit and you look at the fine print, you're getting screwed just as the same as you would be with a credit card.
So the difference is that Affirm can make money two different ways. If you partner with Affirm right now yourself as the customer and you go there, they will say, hey, pay it in whatever increment that you want. This will be the set interest rate that we're offering. And our offer to you is that you probably don't even have a credit card because you're an underserved client or something along these lines. But this is the rate that you will know and we will not change it. Affirm will also sell to merchants like Peloton, for example, saying to the customer it's 0%, but to the actual business it's 14%. So Peloton is actually paying up that 14% for you. But SoFi is not offering either of those. They're saying if you come and use the SoFi Pay in 4, it's 0%.
Yeah.
Where's the money in that? And I don't care if you have a 900 credit score, there's still a risk that you default.
Like I think the switching costs are so low for people. Like if I'm trying to check out with a big ticket item, I don't really care who's offering me buy now, pay later. There's like 7 buttons of like pay with Apple, pay with Amazon, pay with Klarna, pay with Afterpay, pay with Affirm, pay with SoFi. I don't care. There's no brand loyalty there because it's so easy in terms of a switching cost perspective. So to Tanner's point, for them to actually make it financially responsible, they have to get a cut from the actual business to offer the 0%.
I think SoFi is leading not based on unit economics, but like what is the best decision for the consumer, which is what Amazon did, and this is like what Tesla did. I get it. It's not going to be like profitable, but in the long term, SoFi is going to have a lot of data. They're going to be able to provide these are like point of sale loans. Like imagine you're going to the store and you don't have enough money to like buy this thing. And then SoFi is like, you know what? I see your direct deposits. I know how much money you're making. I know like your assets, you're tracking your car, you're tracking your mortgage and all that stuff. I know that you can afford this. We're going to give it to you. And we know that you're going to stick with us in the long term if we make this awesome relationship right now where you can buy this item for work and you don't have to pay an upfront cost. We're going to have your back here, and then they're going to be with us for a longer time. I think in the future, like it's going to pay dividends.
There is a cost that we could get for SoFi Pay in 4, and that would be interchange fee. If you're tapping these cards, if you're paying with this thing, we will get interchange fees. What are the products that people are using Pay in 4 rather than a regular credit card or debit card? Large purchases. In SoFi's current business model, we take a fixed cost anyway. What's even the benefit of people buying something like a $3,000 really hyped up computer on Pay in 4 if we're going to take the same cost regardless?
Affirm, for example, and I know you said it's different, but a lot of the buy now, pay later services, they take a cut from the merchant. That's their entire business model of buy now, pay later. That's how they can offer the 0% APRs. So regardless of the partnership, in order for this to be a feasible launch or to profitability, they would have to take a cut from either the user or the merchant, right? So
Affirm has like something like tens of thousands of partnerships with every company that they have that affiliate with. You know, we're not just walking into a store, tapping an Affirm card and just taking it out of the merchant's pockets. There is an agreement that these companies make with Visa, with MasterCard. So they would have to have this agreement with, I actually think it's MasterCard that's offering us the Pay in 4 solution, but that's really, you know, being offered to us as an extension of a regular card. I don't see the interchange fees being any higher, but the risk is much, much higher.
Is there any possibility of like a synergy between Galileo and buy now, pay later? Like Galileo has this entire infrastructure in terms of the actual payment processing infrastructure, and then they also have a partner network. Could that be one of the ways that SoFi is thinking about offering buy now, pay later, like with Galileo as like a rails essentially?
As a B2B partnership, it might be completely different. They might charge Chime and Robinhood an extra fee on top of that and have them deal with the risk. So that's a completely different side of it. I'm just speaking about SoFi's own bank taking on that as being the first customer of Galileo.
What about like if you have SoFi Plus, you can get that interest-free Pay in 4s, but if you don't, you have like you can do the Pay in 4s, but there is like some like sort of interest.
And it doesn't make sense for them to charge an interest rate because everybody on the user side is such high FICO scores that they can get 0% APR at any other buy now, pay later service. So why would they pay an interest for SoFi? I don't know if anybody has last words. I think all of our links are in the description of this video. So definitely check us out.
All right, everybody. See you guys next time. Bye-bye.
Bye.
Thanks, everybody. See ya.